Greetings, everybody. Let me just make an adjustment here. I think I unmuted myself. Yes. Okay, we're good. Well, thank you all for joining me today. I really appreciate the nice turnouts we get on Mondays, and I think quite a few people also tune into the replay. So I hope you're finding this valuable. Max and Bailey today are finding this a very valuable opportunity to take a nap. It's hard having these King Charles Cavaliers. They're so mellow, they kind of put you to sleep. But I'm wide awake. Hope you folks are wide awake and ready for a little discussion here. Lots to talk about. First of all, I always like to point out what the weather is here, and we got summer weather here. I think it's going to be in the 80s, low 80s here in Long Island. So it's a beautiful day, and so far it's an okay day in the stock market. Not up much, not down at all. So that's a good thing to see. It's been quite a roller coaster ride, as I pointed out in my quick takes yesterday. Quite a roller coaster ride in the stock market. We got to an all-time record high on March 28th. It was really a vertical ascent from October 27th of last year to March 28th. That was just kind of straight up, and a lot of it was tech, but it certainly looked like the market was broadening out quite a bit. But then we've been stumbling here since March 28th, April, and soon May will be upon us. But for April, which is almost over, the geopolitical uncertainties and risks increased during April, especially the early part of the month. And I guess now the markets are kind of feeling a little more sanguine that this last round of tit-for-tat exchange of missiles between Iran and Israel, that's maybe behind us for a while. However, the northern border between Israel and Lebanon and Hezbollah and that part of the world, so that heated up over the weekend. So the geopolitical risks remain a concern, but you don't see it in the price of oil. And I guess the perception is that as long as this is not a direct confrontation between Israel and Iran, as long as Iran's oil somehow or other makes it into the market, even with the Biden administration apparently trying to reimpose some sanctions on that, there's enough oil relative to demand. Today, we're seeing the price of oil down again. So that, in my mind, is one of the key commodities for trying to assess what the global economy is doing. It's not a perfect commodity for indicating that because it can be very much driven by geopolitical developments, but over sort of a broad sweep of things, oil is a good indicator of the global economy. And right now, it suggests that things are fairly weak, muddling along, consistent with our view that the Eurozone, Europe, is kind of in a growth recession. They're not really in a recession, but they're not growing much, if at all. The Chinese data has been looking like it's doing pretty well, but then we look at the Chinese bond yield, look at the 10-year bond yield, we look at the Chinese stock market, and that's been down considerably, except the past day or two. Suddenly, both of them have picked up. And I'm scratching my head here on what's going on with copper. We did detect early on that copper might be breaking out. This was about a month and a half, 2 months ago. There's some indications that copper was breaking out from a downtrend. I do some very amateur technical analysis. It's fun. You can do it at home. Nobody can get hurt by it. But it's certainly gone much past where I thought it could go. And I'm wondering whether that's an indication that, hey, the global economy is doing pretty well all of a sudden. Maybe China is doing much better. Alternative theories are that China's decided that if they can't stimulate their domestic consumers, they're just going to pump out and dump a lot of goods into the global marketplace. And they're making a lot of cars, a lot of um, yeah, electric batteries and solar panels and all the EV stuff, plus everything else that they make. And that requires a lot of copper. So maybe they're just ginning up their manufacturing sector, dumping everything in the global markets. The copper would suggest that the economy's doing better, but unless it's just this is all actually a deflationary last gasp for China. They can't get their consumer going. They can't get their property market straightened out, and so they have to really focus on manufacturing. Another theory out there is that artificial intelligence requires a lot of copper, requires a lot of materials, requires a lot of energy, but we're not seeing it in oil prices or any other energy price at this point. Maybe that's because natural gas prices are near record lows in the U.S. So there's one theory out there that artificial intelligence needs copper for making the chips for putting into servers for wiring up into server farms. But I know the AI story has been hot, but I just don't think it's hot enough in real time to really matter to the price of copper. So at this point, I'm inclined to say it's door number two. If door number one is the economy is doing better, I'm not going to open that door, or I'm not inclined to open that door. I'll maybe take a peek in there. But door number two is the idea that China is dumping goods in global markets, which inherently is deflationary. And the third option is this has something to do. Third door has something to do with artificial intelligence. So that's where I am on that point. But we'll be watching other commodity prices. We've seen zinc, aluminum, and some of these other prices going up. It may just be that suddenly everybody decided metals is where you want to be. Gold, silver, zinc, lead. It's just an odd development here. Maybe I'm just should open up door number one. And the fact of the matter is the global economy is doing better. Maybe on expectations that central bankers are going to be lowering interest rates, particularly maybe in the ECB. That expectation obviously has been diminished in the United States as the economy's performed quite well with inflation apparently stalling out. So last week we had GDP data, we had PCED, the consumption deflator data, and you looked at it at face value superficially, and you could say, we got some stagflation developing here. Well, that's not our position, but as you know, we like to get down and dirty with the data to get a sense of how things are going. So let's look here at the charts for today. Today's Monday, April 29th. I just said that at the beginning, but that's where we are today. And so here's the story on real GDP. Real GDP growth is up here. Final sales is the same thing without inventories. And you can see that there has definitely been a slowing down in real GDP growth. And here it was 1.6% at an annual rate during the first quarter. And this was up 1.9%. I think it was actually 2%. I think we need to round that off, but it was a bit higher, but still on the weaker side. We know that final demand was actually quite strong. Consumer spending was strong. Business spending was strong. There was some inventory. A slower pace of inventory accumulation is a downer for real GDP growth, and imports were very strong. So again, final demand was strong, and some of that final demand was met through imports, and that tends to be a drag on real GDP. So on the inflation front, we also got some data. When GDP comes out, we get the deflators, the GDP deflators. Here's one that's the core personal consumption expenditures deflator, and it really rocketed up to 3.7%. So it really came up sharply. It had been 2%, and that's on a quarter-over-quarter annualized basis. I look at those, but I also look at the year-over-year, and the year-over-year still looks like it's moderating, behaving down to 2.9%. So these things, as Jay Powell said, Fed Chair Jerome Powell said these things don't happen without some bumps along the way. And there was something going on in the first quarter, but I don't think it was the beginning of a second peak inflation phenomenon like what we had in the 1970s. And I still think that a lot of this will moderate. A lot of it seems to be still somewhat pandemic related, but it's not just that. I think where we really still have a problem is with auto related costs. We're seeing motor vehicle insurance still going up. We're seeing that maintaining and repairing cars is going up. I'm going to write it up, but I think one of the reasons this is all happening is if you kind of look around you while you're driving. I hope you're looking around you while you're driving, but look for SUVs, and you'll see that the bulk of the cars on the road are brand new SUVs. People have really been splurging on these monster cars, and they're not cheap. They're very expensive to repair. And oh, by the way, some of these electric vehicles, if you suddenly have a problem there, it could cost you thousands of dollars for repair. They seem to have fewer parts, but somehow or other, repairing them can be extremely expensive. So I think because we're all driving, not all, but because a lot of us are driving bigger. I'm still driving a Subaru, but my friends are driving bigger cars, and so that all means that motor vehicle insurance has gone up, repairs have gone up, and I don't think it goes up forever. And I think the increases we've seen of late have been such that we're bound to see some slowing in all that activity. Here's another happier chart than what we just saw on a quarter annualized basis. Again, first quarter was up 1.6% for real GDP. If we take the year-over-year percent change, we get 3%. 3% looks pretty good. As a matter of fact, we've now got this functionality with our new charting application to take an average over time that just so automatically updates. So it doesn't change much, obviously, from quarter to quarter, but it did average 3.1% since the late 1940s, which is exactly where we are. So that's encouraging. That shows the economy is still doing reasonably well. Another indicator that came out last week that's a positive one, a happy one, is initial unemployment claims. They were 207,000. This thing's been extremely low for quite some time, and it clearly correlates with the unemployment rate for obvious reasons. But the latest numbers suggest that the unemployment rate may very well have stayed below 4% for the 27th month in a row. So when it comes to the dual mandate, the Fed's spot on in terms of the mandate to keep us at full employment. Now they're just trying to get the inflation rate down without terribly disturbing the labor markets. I think that can be done. Powell thinks that can be done. There's a lot of people who have been and maybe continue to be skeptical about that possibility. Let me take a little wet my whistle. Okay, let's now talk about the inflation deflators that came out on a quarterly basis, and then look at it on a monthly basis. So, you know, when GDP comes out, it's quarterly data, and with that comes GDP deflators, quarterly data. And then the next day, we get personal income and the price deflators for consumption. But this is kind of interesting stuff if you're into it. Join me here, GDP deflator, personal consumption expenditures. You can see that we're still have deflation in durable goods. We're down 2.1%. Non-durables is up 0.8%. So those are behaving themselves, these two. The services is still a problem at 4%. Maybe it came down on a year-over-year basis, but it kind of came down at a slower pace. So we do still have an issue in the services components of inflation. This is another slice and dice of the actual and core inflation rate, and they're both still coming down on a year-over-year basis for the overall GDP. I thought it might be interesting to look at some of the other components, because we always focus on the consumer, but you know, their consumer is not the the whole story. That's a big part of the story. But look at residential fixed investment. These deflators are available quarterly, and you can see that they really spiked here over the past couple of years, but they've come down substantially. Pretty close to zero or low single digits. We can look now at the deflators for, let me see, what was that? That was non-residential fixed investment. So it's capital spending. And so capital spending inflation was high, and it's come down dramatically. This is residential investment, same story, big peak. A lot of this is pandemic related, one way or the other, and it's kind of self-corrected. I'm not sure that tight monetary policy explains all of the reasons why inflation has come down. Sometimes I wonder if we could do an experiment and see what would happen if the Fed only raised rates half as much, whether inflation would have come down. Maybe not, but again, I think a lot of the inflation was pandemic related. It was a shock. The shock dissipated. There were some aftershocks, but all in all, inflation's been coming down. Here's another important one related to the overall economy. This is import prices, and you can see that import prices are still falling on a year-over-year basis. I've in the past pointed out that one of the reasons we didn't have to have a recession to bring inflation down is because the Chinese are having a recession, and they're increasing their production and exports and dumping goods into the world markets, and so we're importing from China with prices actually falling, and that's still visible in this chart from the GDP report. What else? We got the personal savings rates. Yeah, let's talk about the consumer a little bit. The consumer's still hanging in there quite well. I think the increase was something like 3% in the this first quarter at an annual rate. And by now, the consumer was supposed to have been retrenching. They were supposed to have run out of excess savings, and they were supposed to cut back on their spending, causing a consumer-led recession. And it hasn't happened. Maybe it could still happen, but I seriously doubt it anytime soon, anyways. But you can see that the personal savings rate actually went down. Now we're looking at monthly data, so it went down to 3.2% in March. Look, I think the savings rate's going to remain low around this level through the end of the decade. And I think a lot of it has to do with what we've talked about before, retiring baby boomers. They are retired. They're not getting income anymore, so they're not saving out of earned income. And maybe they can sustain themselves by living off of the interest and dividend income from their assets. But presumably, the reason you accumulate retirement assets is so you can retire and use the assets to live on. And so I think the savings rate is going to remain low. And so this excess savings theory that said the consumers are going to eat up all their excess savings and then they'll have to increase their savings rate, that doesn't make sense to me. It's certainly not working out. The other thing is, it wasn't just excess savings. We have seen an upward trend in inflation-adjusted disposable income. Employment's been growing. And at least last year, we finally saw that real wages were growing as well. In 2022, they were flat. They were stagnated. But starting in 2023, real wages increased. So that plus employment means that the purchasing power, the traditional source of purchasing power, what consumers tend to spend is disposable income. And disposable income times the savings rate, basically, the disposable income, it tells you what they have and then how much of it they save and take out of that disposable income, and the rest is consumed. Maybe it's kind of hard to see it on these scales, but we're looking at relatively solid increases in growth rates of consumer spending in real dollars for total goods and services. So the consumers are spending. Now let's look at residential investment, kind of coming back to the quarterly data that we had in the real GDP numbers. We did start to see the beginnings of a recovery in residential investment. And this is residential investment adjusted for inflation, 2017 dollars. And you can see that the home improvements seems to have bottomed. This red line is the single family, and this is the multifamily. The multifamily has been quite strong, but there's signs that there may be some overbuilding going on, and developers are cutting back on this kind of construction. Of course, interest rates, mortgage rates have gone up, so you can expect that this might actually roll over. But I think we're more in a bottoming phase than we're going to be in a continuation of that recession. So it's still, in my mind, a rolling recession scenario. This is more data on the multifamilies, and you can see that multifamily starts have taken a dive here. Multifamily completions are up a lot. So, if you look around your neighborhoods, you might notice that there's a lot of new apartment buildings that have been put up, especially down south, and now they're taking on tenants, and that's one of the stories for why rent inflation should be moderating and has been moderating and should continue to moderate. Capital spending, well, interest rates, capital spending is supposed to be interest rate sensitive. Interest rates are supposed to knock it down. Instead, it went to an all-time record high with no signs at all, really, of a recession in capital spending. So that's quite impressive. Let's look a little bit closer at the details here. We've got the intellectual property, which includes software and R&D, and you can see that's the blue line here, all-time record high. Kind of stalling here is what people pay for equipment, servers and the like. And you would expect with the AI boom that would be starting to pick up as more of these data centers get completed. They're going to be full with computer and other electronics, and certainly loaded up with software. And this down here is structures, and structures has been making some comeback here. It seems to be flattening out here, but we'll see in a second, exactly 1 second, that we still have a lot of strength in the construction of manufacturing facilities, all-time record high. This is from the real GDP accounts. We also have monthly data in nominal terms for this, and all confirms that onshoring facilities continue to be built. This is, again, more slice and dice. This is, for those of you who might be interested, this is in current dollars. So what are the size of these markets? Computer and peripherals, at an annual rate, we're talking about over 160 billion. This we're talking about over 650 billion for software. R&D is a big one. Remember not so long ago, people were complaining that we weren't doing enough R&D. Well, apparently we're doing quite a bit of it now. Really, it's been on fire for quite some time. So the R&D is the green line. It's actually the biggest component of these high-tech components. And then there's so we've done that with research development. This is the computers, and over here is other information processing equipment. So R&D and software are the components of intellectual property are absolutely on fire. This is a chart that many of you have told me you'd like to look at it on an updated basis. Well, here it is. This is the percent of capital spending that's spent on high tech. It's that which includes, as you can see from the footnote here, high tech equipment, software, and R&D. So it's been running around 50% here for the past several years. Pandemic obviously brought in a lot of spending on technology so that people could work virtually from home and other places. But this has been an ongoing upward trend. This actually understates the importance of technology and capital spending because, for example, industrial equipment or a truck or trucks used for commercial freighting services, those are not included in information technology. But trucks these days are devices attached to software that is logistics software that runs these things. Industrial equipment is lots of high-tech equipment with software that does things, that builds cars and manufactures things, and that's not included in this data here. So again, the high-tech revolution is awesome, and more awesome than the numbers suggest. I mentioned inventory investment has been slowing down. Arithmetically, real GDP is way down when companies invest at a slower pace in inventories. So that's what's going on there. I mentioned that imports, this is the blue line here, I think it was up like 7% at an annual rate. So our economy is doing well. We're meeting some of the demand for goods from imports. Quite a few of those imports are from China with falling prices. So we're importing deflation from in the goods markets. So I'm not concerned that the goods inflation rate is suddenly going to be making a big comeback here. By the way, this is also a useful indicator of global economic growth, since the U.S. is the 800-pound gorilla in global activity. And you can see that both the exports and the imports have been kind of flattish, stalled, suggesting that the global economy is not so hot, which has been our position, that the U.S. economy is doing very well, rest of the world economy not so great. This is government spending in GDP is the nominal number here. And you can see that the government spends about $2 trillion at an annual rate. And yet total government spending is over $6 trillion. So what's the difference? Well, take the difference, and that's basically income redistribution, which is what we have here as the blue line. So back to inflation on a monthly basis, it's tracking pretty well relative to our forecast. We made this forecast back in the summer of 2022. We mapped out these lines. We haven't changed them. So things are working out quite well in that regard. And we still think we're going to be looking at, by the end of the year, falling closer to 2% than being at 3%, and then kind of staying there for a while. But there are things to be concerned about, and reasons why the Fed is, well, Powell on Wednesday will say that, we've been making progress, but there's bumps along the road, and here's a bump. This is the core PCED on a 3-month annualized basis, 4.4%. Looks pretty good on a year-over-year basis, 2.8%, but on a quarter-over-quarter basis annualized, not so good. And again, some of this is auto-related inflation, maybe some healthcare inflation too, particularly with the health insurance. Personal consumption expenditures deflator for goods. Again, no problems there. You can look at that on your when you like. This is services, and I put all 3 major components here. Powell came up with this idea of the super core services inflation rate, which is services X energy, X housing, and that's it's kind of stalled here at 3.5%. Let's look, yeah, right around there. So, oh my God, inflation's not coming down. But they were saying that about it, super core, when it was at 5%, that it was kind of stuck here and it wasn't coming down. Then it came down. Now it's stuck at 3.5%, but I think it's going to come down. And then this is the overall services, and then you've got the housing and related, which is the laggard at 5.8%. We think that's going to come down. Yeah, I know this was one of my longer set of charts, but there were a lot of interesting new material to cover I wanted to share with you. I'm almost done here. Here's the super core inflation rate all by itself, and you can see the 3-month is 5.4%. So it's not something I'm worrying about, but I'm only worrying about because the Fed will probably, and Powell will probably say that he's back to focusing on the super core, and he's not happy that it stopped moderating. And then, of course, the Fed looks at inflationary expectations. They came out last week for the Consumer Survey Research Center, and you can see there's a slight uptick. Gasoline obviously had something to do with it. But all in all, it looks like inflation's expectations are down pretty well. So sorry for that long-winded presentation, but I hope you got something out of it. Meanwhile, let's see who's, yeah, they're still snoring away, having a good time here. By the way, we started to train Cooper, the 3-month-old puppy we got, also King Charles. And so when she runs out in the yard and we say, "Come, Cooper," we give her a little snack. And we just did the same with the other dogs, but we haven't done it in a while. Max figured out that all he has to do to get a treat now is just go out the door and come right back in. So even if he doesn't really need to go out in the great outdoors, he goes out for a second, comes back in, and then looks at us like, "Where's my snack?" Anyways, let's do a couple of things here. Okay, Willem, nice to hear from you. Willem, I agree that the U.S. is likely to have entered a stagflation episode. Is unlikely. Okay, it's unlikely to have entered a stagflation episode I expect the lower GDP growth in Q1 2024 to be followed by somewhat stronger GDP growth for the rest of the year. Does this not mean that if inflation stays materially above the 2% target for the rest of the year, the next move in the Fed funds rate could be a hike rather than a cut? Well, as you know, Willem, there's been more discussion of that possibility. When people were talking about 6 to 7 cuts at the beginning of the year, we weren't doing that. We were talking about 2 to 3, but everybody was talking about cuts. Nobody was entertaining the totally contrarian viewpoint that the next move might actually be rate increases. But I think the Fed's party line is going to be that they're pretty comfortable with the Fed funds rate of 5.25 to 5%. That's restrictive enough, and that over time they think that'll happen. But if you get your scenario where the economy is strong and inflation is more persistent at something like 3% and doesn't look like it's coming down, then that's a possible scenario that they would have to consider raising rates. But you have to be open-minded in this business, as you know. And right now, my mind is on the idea that the Fed is done raising rates. This could be the long pause. Everybody I think got fooled by the history. Everybody is a chart historian, and we've all looked at the Fed funds rate and look, it peaks and then it comes straight back down. But if you draw lines for financial crises, you'll see that in the past, it's usually peaked when the financial crisis hit and they scrambled to lower rates. This time around, they figured out that they can provide liquidity facility for the banks, and then they don't have to lower interest rates. The liquidity facility will stabilize things. I think a couple more here. Sorry, again, I didn't leave much time for Q&A, but what do you think Jay Powell is most likely to do on Wednesday? Lean hawkish and hint the possibility of hikes? Yeah, he could lean hawkish, I suppose. I think he's got to stay kind of somewhat consistent, and it would be totally consistent for him to say that, I told you there'd be bumps along the road to lower inflation, and this looks like a bump, and we still think that we're on the right track with interest rates, keeping interest rates where they are, and we're not going to rush to lower interest rates, certainly under the circumstances. And that should be the end of that should be a pretty close summary of what he's going to say. But he's surprised me and he surprised others in the past by suddenly changing his tune, by the so-called pivot. But I don't expect a pivot from his previous pronouncements. Matthew, do you think the trajectory in the last 3 months S&P Global Services PMI could result in a lowering of Q2, Q3, Q4 forward estimates? Look, those PMI indexes are basically derived by asking purchasing managers and others, is your business better, the same, or unchanged, better, the same, or weaker than it was a month ago? And so at some point, these indicators are diffusion indexes. They don't go straight up. They don't go straight down. They are cyclical. I don't see anything in the services global economy that suggests to me that the service economy is suddenly going to go limp on us and create a recession problem. Gus asks about the Japanese yen and the impact on markets. Yeah, I think there is this perception, particularly among Forex traders and derivative traders and others, that what happens in Japan doesn't stay in Japan, that it matters a lot to other markets. Some people have told me that they attribute the backup in bond yields last year from 4.25% to 5% to the Japanese central bank suggesting and implying that they were giving up on the yield control. And well, they did, but they certainly didn't go ballistic in terms of tightening. It's been a pretty weak kind of tightening measures. But I think we're seeing just some volatility in the exchange markets because people are speculating that if this thing just keeps being weak, the Japanese will have to intervene to support it. But I don't know that there's a lot of moving parts when it comes to the markets, and I don't know that would be something that would create a major problem for our markets. Thank you all for joining us. See you next week.